Good morning from overcast and cool Chicago, which is ecstatic right now following the Bears' victory over the Kansas City Chiefs on Friday night preseason football. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, August 24th, 2025. In today's podcast, our focus is on the S&P 500's current 34% rise since the April lows and its continued sustainability on the heels of Friday's 97-point rally in the index that was driven by Federal Reserve Chair Jerome Powell just hinting at potential interest rate cuts in the near future during his Jackson Hole speech on Friday. In the meantime, however, looking under the hood of the market, some of the April rally's leaders, the leadership that really took the April rally and carried it upward, have stopped leading. Sector rotation has become very defensive very quickly, and seasonality in the S&P 500 becomes decisively bearish between now and the first week or two in October. So outwardly, market looks great. Looking under the hood, there's some reason to get my attention. Not a sell yet, but there are a couple of cracks in the uptrend here that could, should they continue, become problematic. We actually moved back to a bullish risk-on bias on April 23rd after avoiding much of the 19% decline from the February highs in the S&P 500 that preceded it. But now, following this enormous rebound in just a little bit more than 4 months, the risk-reward scenario is nowhere near as good as it was back in April or even in May. So now our focus is shifted to making sure that we take these profits that we've accumulated by buying in late April, we're able to take those to the bank before the next inevitable correction occurs. It will come. Our data-driven metrics, including the Asbury 6, which we're going to take a closer look at in just a couple of minutes, are going to help us to do just that, is try to capture most of this move before we have to kind of start the cycle again and start to play defense. Before we start, here's just a little bit of information about us. Asbury Research is a registered investment advisor and has been providing both investment research and asset management to individuals and professional money managers since 2005, which makes this our 21st year in business. We have 2 levels of research service available. We have our flagship Asbury Premium for more serious investors, for more sophisticated investors, and for investors maybe that have a little bit more time to actually execute the orders themselves and enjoy the process of this. It includes the latest updates on all of our data-driven models and some personal instruction on how to implement them in your portfolio. We also have our entry-level Substack newsletter, which is right here. $25 a month. Does not include any of our trading models, but has selected excerpts from our premium research product. We're going to look at one of those called the Sort Report here in just a minute. That's asburyresearch.substack.com if you'd like to give it a look. There is also a free version of that service. So if you like our videos, if you like our approach to the markets, if you're following us here on Follow the Money, I strongly suggest that you sign up for the free version of the Substack. It's a no-brainer. There's a lot of videos included in there, a lot of links to different places on the internet who interview us. So again, you could sign up for that for free at asburyresearch.substack.com. Next, we also offer managed accounts for both individual investors and now also for financial advisors and portfolio managers as a third-party manager. We're starting to do a lot more business in the managed accounts area because there's a lot of people out there that like what we're doing, but they either don't have the time to read the research or they don't know how to implement it into their portfolios, or they don't have the discipline to follow the research just as it is. They start to drift. They take some of the ideas, they don't take the others. And for these people, we've decided to offer a managed account. We have 4 different model portfolios to offer there. Year to date, 3 out of the 4 of them are Asbury Aggressive, our Asbury Balanced, and our Asbury Conservative. Aggressive, Balanced, and Conservative are all outperforming the S&P 500 and with a lower drawdown and better risk-adjusted numbers than the S&P 500. Our Asbury Aggressive model currently outperforming the S&P 500 by 6.7% year to date, with more than a 3% lower drawdown than the S&P 500. Better performance and less risk. At the other end of the spectrum, our Asbury Ultra Conservative model, Ultra Conservative, is trailing the S&P 500 by 2.4% year to date, but its maximum drawdown was only 6% compared to 19% for the S&P. So less than a third of the drawdown. So for those of you, if you're older, if you're more risk averse, you want something better than bonds, a treasury bond or a T-bill, this might be a great way for you to play the game with a lot less risk. Here's a look at 3 of our 4 model portfolios. I think a picture is a lot easier to understand. So what we have down here in purple, AOR, is an ETF that emulates the 60-40 stock and bond portfolio. Typically, if you go to an advisor, they're going to talk you in, they're going to suggest something like this. It's the standard. 60-40 stocks, bonds, it's supposed to protect you when the market's going down, the stock market's going down, by having 40% bonds in your portfolio. That those who have been using this kind of an approach know that that is certainly not true all the time. Here is our ultra conservative here in green. You can see it's significantly better than a 60-40. In blue here is our Asbury Balanced, and up here is our Asbury Aggressive. So just to get a little bit of a visual there, contact us via the contact tab at asburyresearch.com if you want further information on any of these, or you want to set up a Zoom with us and we can try to give you a little bit more information there. So let's get going on markets. I know that's why you're here. Let's start out by looking at the Asbury 6. So the Asbury 6 shifted back to a positive bias on August the 12th, as indicated here, from negative on July the 31st. Here was July 31st. That was a top for about 2 or 3 days. But you can see this model is active. It's about 4 times, it has about 11 round turns a year. So it goes from positive to negative about 11 times a year. It's a daily data-driven gauge of the U.S. stock market's real internal health as part of the premium research service. We look at 6 diverse metrics, which we selected and put together as a team, so to speak, via quantitative backtesting. Every individual indicator has an Achilles heel. No indicators, I've been doing this for 43 years now, no indicator's perfect. They all have periods where they don't work. So we found 6 that are pretty different from each other, and we put them together as sort of a team. You could see it's very busy, but year to date, the A6 has slightly outperformed the S&P 500, but with only half the drawdown. The drawdown in the A6 was 9.6% versus 18.9% during the drawdown during February through April of this year. 8% lower standard deviation and less than half the beta. This means the Asbury 6's volatility is significantly lower than the overall market and indicates more steady returns with lower risk. Let's look at this for just a minute. 4 of 6 are necessary to have a directional bias. So 4 green or bullish are necessary to have a positive bias in the Asbury 6. 4 more of these would have to turn to red in order for us to turn negative on the market. Again, this is a very sensitive indicator. I kind of equate this to an EKG for the stock market. Let's move back to our charts here and look at the A6. This is since inception. The green line is the A6. This is daily going back to the beginning of the 4th quarter of 2017. And the blue line is the S&P 500. So The downside, again, for some investors might be that the Asbury 6 is too active. We tend to use it as an indicator rather than a model. But the upside is that the A6 has outperformed the S&P 500 85% of the time during this period. And that's why you see the green line up above the blue line most of the time. Well, that number is actually 85%. So that's basically for 1,668 of the 1,942 trading days during the period, the Asbury 6 has been above the S&P. It's outperformed the S&P. The next thing we're going to move to as we go back to the research center is we're going to move to the research center and we're going to look at the correction protection model. The correction protection model is also a risk on and risk off model, just like the A6, but it's much less busy and it has a component built into it to try to stay with the market as long as possible because the market has an inherent upward bias. Over time, the S&P goes higher most of the time. When it goes down, it could be heart-wrenching, it could be pocketbook wrenching, but this is meant to keep you in the market most of the time, but get you out of the way when things get shaky, which they did in the first part of this year. So CPM is a completely data-driven dynamic stock bond allocation. This was actually built to replace that 60-40 bond allocation that we just looked at in a line chart just a little bit ago. So here's the chart. We are risk on in the CPM since April the 24th. So we caught this entire move, and you can see we're in and out a little bit from the move from the highs earlier this year, but we avoided most of the drawdown. So basically, the S&P drew down 19%, CPM drew down about 9%, which means when you get back into the market, you're getting back into the market at a higher level, so to speak, because you didn't take the entire drawdown. It's designed to protect investor assets during a market decline, eliminate large drawdowns, and reduce volatility in portfolios by moving the assets out of the market during adverse conditions. It's binary. It's either on or off, in or out. What we generally do, this is a part of the model portfolios that we've built. Many, if not all of those model portfolios have a piece of that in CPM. Again, annualized about 5 round turns a year. And does much better than that 60-40 stock bonds allocation. Now let's take a current look at sector rotation. I had mentioned sector rotation turned defensive. We're going to do that by going back to the research center, and we're going to go to our CEF model. Our CEF model is another model that is part of the model portfolios that we offer for managed accounts. Here it is here. So the CEF model, completely data-driven sector rotation model. It was created to quantitatively identify long overweight opportunities in U.S. market sectors by following the money as it moves around those 11 sectors. Here's the current model. We had been overweight XLK, which is the technology sector spider, since April the 28th. Captured a nice profit. We were in and out of there once or twice, but we captured most of that outperformance off of the 428 low. But we exited that overweight on Friday. You could see technology, as of this past Friday, through the data on Friday, technology fell to pretty near the bottom. Look what replaced it. Utilities, a defensive sector, XLU. Healthcare, another defensive sector that's been downtrodden all year, XLV. And staples, XLP. So this, anecdotally, this doesn't happen very often, where you have a very positive bias in CEF and suddenly everything flips and everything is defensive. That's where we are. It indicates a pretty decisive shift in asset flows towards a defensive staff. And despite Friday's huge rally, driven by just a few words by the Fed chair, we think the movement of money is much more important. Let's move forward. By the way, the Asbury 6, the CPM model, and the A6 are all part of Asbury Research's premium research service. Contact us via the contact tab here, and we'll be happy to send you more information about those. Let's talk about drawdowns a little bit. I always harp about how important it is for drawdowns to be recognized. They could do a lot of damage to your portfolio, especially if you're older and you're starting to take a withdrawal from your money. As you can see, I'm an older investor. Many of our clients are older investors. When you're in your 30s, I have two sons in their 30s, you're dollar cost averaging. This is like playing in the first half of a football game. You can make plenty of mistakes and take some chances and still be fine. Once you start approaching your 60s, now you're playing in the fourth quarter of your football game in the stock market, let's call it. And if you've been investing for a while, you're probably playing with a lead. That means in the fourth quarter, I think you take what the defense gives you. You don't make any mistakes. You don't make any careless mistakes, which in investing means you don't make emotional mistakes. Emotional mistakes are what makes you buy the top of the market and sell at the bottom and then be too afraid to get back in when the market starts to go back higher. So look at what some of this looks like. If you draw down 20%, if the S&P 500 draws down 20%, standard drawdown, I'd say, you got to make 25% back the other way in order just to get to where you were at your prior peak. This is a little bit more meaningful for me because COVID was a 34% drawdown in the S&P from top to bottom. So this shows 30 and 40. If you draw down 30% in the S&P, you got to make 43% on the way back. If you compound that by taking money out of the market for your distributions, it could drain your account a lot faster than you thought. When you were doing your calculations to see how much money you needed. We actually wrote a paper on drawdowns. If you're interested in that, you can contact us at asburyresearch.com, ask for it, and we'll send it to you. Next thing I want to do is look at more current market stuff. So we're going to go back here to the Research Center, and we're going to go to Keys to This Week. Keys to This Week is one of the standard reports in Asbury Premium. A version that looks a lot like Keys to This Week is also available in the pay version of Substack for $25 a month too. So this is, if you're wondering what you'd get on Substack, this is part of what you're going to get. Let's look at some specific charts here. Chart 2, this is the NDX. This is a NASDAQ 100, large cap technology. This is the NDX relative to the S&P 500, the blue line. It's a relative performance chart of NDX versus SPY. On April the 25th, NDX started out, the NASDAQ 100 started outperforming the S&P 500 on April the 25th. That was the case up until August 20th, just a couple of days ago. Now we're edging down underneath that 63-day moving average. Why does that matter? It means we're losing our leadership. I mentioned that at the very start of the video. Look what happened back here in February and March when that same thing happened. NDX started underperforming SPY right here. That gave us all of this. Nobody knows what's going to happen tomorrow or next week or next month. But if we continue underperforming, if the NDX keeps underperforming the S&P 500, it's very likely we're going to go into a correction. So this is a big area of focus, something that we've been watching like a hawk for the past week or so. Next, SOX index, semiconductors. Another part of the market that often outperforms when the market's going higher. It's a leader. Look what's happening here. The SOX, and at the middle of August, it tried to and failed at making a new all-time high, taking out 59.32 from July of last year. Now look what's happening with the relative performance chart. It hasn't actually broken down through that 63-day moving average yet, but it's losing its mojo. It's losing its momentum. If SOX starts underperforming SPY on a 63-day basis, and the same thing happens in the NASDAQ, the market has problems. And we're probably going to go into some kind of a corrective period. Here's the third one. It's a little abstract, but it's one that I like to look at to tell me what the risk appetite is. Down here in blue, it's the relative performance of GBTC, which is the ETF that tracks Bitcoin, versus the S&P 500. I look at it like the top of the scale in terms of risk appetite. You're buying Bitcoin. I want to know how that appetite relates to the S&P 500, which is your kind of standard for a buy and hold account. As of August the 18th, Bitcoin is now underperforming the S&P 500 right here. Look what happened when this happened back. This is right at the beginning of February, right here, through April the 16th. That's this piece right here. So actually this preceded, maybe by a week or two, the February peak that we made in the S&P 500. I don't like this. If this doesn't straighten itself out over the next few days, I think it's a real problem for the market. Keep in mind, the Asbury 6 is still 5 green and 1 red. Unless that turns to 4 red, selling here is too early. That has to be confirmed for us by the Asbury 6 and also by CPM, which we just saw just a few minutes ago. But I don't like some of the cracks in the foundation of this uptrend, and these are 3 reasons why. Here's the 4th, and there's more, but these are the ones we're going to talk about today. This is VXX. VXX is basically a futures version of the VIX. It's called the iPath Series B S&P 500 VIX Short-Term Futures ETM VXX. It's almost a sentence. But here's what I'm looking at here. Very, very low, meaning complacency in the market. The market is fearless right now. Back in July of 2024, Dece of 2024, and February 19th of this year, which is right at the top, we had extreme lows of about 40 in VXX. Look where we are now. We're right there again. Actually, we're a little bit underneath that now. It's not a sell signal, but it tells me the market is complacent as it was back in those other dates, and it tells me be careful. There may be a market peak coming up here because the market is a little too carefree. Finally, the last thing we're going to look at is the sort report. I had mentioned the Substack service. Part of the premium Substack service is the sort report. And here it is. Let's make it a little bigger. Sort report tells us what parts of the global market have positive trends. 1, 2 are outperforming their benchmarks, and 3 have positive asset flows, which means that new money is coming in and shoving those prices higher. We look at a wide array of different asset classes. Let's talk about the 3 green ones first. These are positive on all 3 of the categories that I just mentioned. Global equities ex-US. This means foreign equity markets. Small cap and emerging markets. 2 of these 3, some people might look at as alternative to the S&P 500. So it's another kind of a defensive tilt. And then you can see everything else there. We cover interest rates, technology, commodities, crude oil, gold, crypto, dollar. But right now, these 3 are the ones that are kind of clicking on all cylinders. This is a very low-cost way to make better investment decisions that are based on data, not on opinions or economic forecasting. Remember, forecasting is a euphemism for guessing. Here on Asbury Research, we truly believe in following the money. So there you go. That wraps up our latest Asbury Research Following the Money podcast. And our next one is going to be 2 weeks from now, tentatively scheduled for, what are we? Today we are the 24th, so we're looking at the 7th, September 7th. We'll already have gotten Labor Day behind us. I expect a lot of activity and a lot of angst in the markets. Thanks for listening. We appreciate the positive feedback. If you like what we're doing, make sure to hit like and subscribe, and we will see you right here in 2 weeks. Thanks.